Good Monday. This is Jay Brew, co-chairman of Seafried and Brew. As we're under pressure in here in terms of the lending functions that so many community banks talk about, the fact that loan volumes are difficult to keep up, to grow in here right now, is that I think that in some ways we can think differently. And what I'd like you to do is to think about something uncommon. In fact, what I'd like you to do is to go to uncommonmortgage.com. And on uncommonmortgage.com, what you'll see is the offering of mortgages by the bank that I'm a founding director at. That's Embassy Bank for the Lehigh Valley. But we've set up a new marketing program because as, of course, refis are down in here, we as a bank want to get a larger and larger percentage of the regular market share in our franchise area. And to do that, we've come and used a product really since we opened the bank, which one would call an uncommon mortgage. So go to uncommonmortgage.com and you can read about this in terms of how we do it. But the way you want to think about this in terms of the structure of mortgage product is that with conventional mortgages backed by Fannie Mae, Freddie Mac, is when you look at that structure and the problems now around making those mortgages, that you essentially develop a stack of paperwork that of course is like a huge volume. Well, how can we get around that from the standpoint of not having to put our clients through that excruciating pain of doing this full documentation and yet still have enough documentation to do our due diligence? The way that we do it as Embassy is we do it as a second mortgage. So we're doing the primary as a secondary, which basically allows you to get around doing a lot of that huge amount of paperwork that you have on a conventional mortgage. So once again, what you can do is that you can come in and really lessen the time, lessen the headaches, and be able to get the people what they want. It's also a way to do more jumbo-type mortgage financing out there, so that you can look at relationship-type accounts with doctors and other professionals that may be looking for more jumbo financing and realizing that in a lot of places that's more difficult to get than ever before. So when you also think about it, what we do is we do it as a bi-weekly mortgage. And once again, being uncommon in the marketplace, you can tell your customer that they'll pay less interest, they'll pay the mortgage down faster over time than if they did more a conventional mortgage. But as I talk to banks in terms of strategically, the strategic portion of doing a bi-weekly mortgage is that it brings in the cash type deposits, those checking, savings accounts, because they have to have that primary account with you. So as you're looking at doing mortgage lending in here, that essentially this is a key strategy that you build the relationship with both the checking account and the mortgage. You also might sit there and say that these mortgages are not able to be sold into the marketplace and that you'll have to hold these mortgages, and that is true. You might sit there and say, well, Jay, at this low of interest rates, does it make sense to do that? And as I've said before, what you really need to know is what kind of volume that you can do of this type of asset in relationship to all your assets and liabilities. Certainly, if you can build up more core type, those cash type deposits, the checking, the savings, and the now, that gives you ability to take on more of these assets. So on an overall basis, one has to understand the risk, but not just of a fixed rate mortgage, but how it fits into your entire balance sheet. This is Jay Brew, co-chairman of Seafried and Brew. Have an uncommon week.